Welcome back to the channel. I hope you're having a great day or start to a new week, wherever you are around this beautiful planet of ours. Today, we continue with our macro series on answering the massive question in the market: is the bottom in? Are we expecting a further huge collapse in assets like real estate and stocks, or is this bottom actually the bottom? Can we expect better prices through to 2023? Today's video, we're going to look at a major cycle coming up for traditional stocks and how this relates to cryptocurrencies, in particular Bitcoin, the god market of cryptocurrencies. So stay tuned to the channel, follow us here, subscribe, bell notification, and of course like the video up if you haven't already. I'll remind you again at the end of the video if you prefer to wait and see what is in store for this particular video. Guys, today's video, we are looking at a major 4-year cycle which has been around since the dawn of time. The dawn of US time, that is. And of course, the US being the biggest market in the world affects everything that we do. That's why it pays to pay attention to this particular market and this cycle here. So we've got a lot of data and a lot of charts to get through in this video. Nothing new to what we always look at here, but we basically want to be answering that particular question about the bottom. While everyone else is calling for bigger, scarier, massive downside, we have to start looking at the possibility that that may not happen. Remember, nothing is guaranteed, but in this particular case, there's a good possibility of us seeing higher prices into 2023. In fact, an approximate 80 to 90% chance of us seeing high prices on the S&P into 2023. Absolutely crazy, some might say. Some might say this is not possible at all, especially with the looming recession and the bad news that is continuing to play out day in, day out on our regular media. But of course, we're looking at this from the eyes of an investor. We want to be on the side of the trade and understand the timing within the market and know that the news is almost 100% wrong when it comes to investing. It is just there to report to us what they think is important at this point in time, essentially what people are clicking on. We want to stay away from that because we are investors here. So the cycle that we are looking at today is the president cycle. So the presidential cycle and the SP 500. So this particular data here goes back to 1945, but I've found many other times in history that you can almost go back to the dawn of time for the US. This one in particular goes back to 1833. And so what we're seeing here is leading up to an election year, the midterm year, which is what we're currently in 2022, does not give great results for the S&P. But the following year, the pre-election year, more often than not does. And we can look back at any point in history and see that more often than not, like it says in this particular data here, 88% of the time, the third year, basically next year, 2023, should give us much better gains than what we've seen in the other, or in the previous year, or the current year that we're in, the first year of the cycle, and the fourth year of the cycle, basically when the election is on. It has the highest probability of giving us better gains. Before we dive further into that particular cycle, let's take a look at the midterm years just to see how this has progressed so far. Now, all of these charts have been up online for a very long time. You can see here that this particular one goes back to 1900, and the last time they recorded it was 2016. So sure, it's a few years old here, but you've got 116 years of data. And we've continued to see this yet again. So let's just take a look at this as it is almost identical to what we saw this year. Check out the graph along the bottom here. You've got all of the months, and then you've also got the pricing of the Dow Jones. And of course, the Dow Jones moves quite similarly to the S&P. What has this got to do with Bitcoin? The main thing is we want to see that there is strength in the overall markets, in the traditional markets where the big money is, so that we can see some of that money flow into Bitcoin and eventually cryptocurrencies. So check this out. This is absolutely phenomenal how close it was to this year. Now, this is just showing that the Dow had a bit of a top here for January. It moved up into April. It dumped into late September, maybe even a day or two into October, and then has risen out into November, a little bit of a top here in December, and it is predicting that the market should continue to move up into December, potentially for that Christmas rally. And if we take a look at what happened for the Dow Jones, we can see that we had a peak here in January yes, the market did drop, but it also had another peak in April. Basically, depending whether we're in the S&P or the Dow Jones, we've got a top late March, early April. Same sort of thing happened on Bitcoin as well, which is why this is so important to look at. We just get so many more decades and potentially centuries of data that we can then use in the analysis for Bitcoin. We had this first dump into June, a pump into August, and then this final or potentially final dump into the mid part of October. And in some cases, we had a low here in September as well. So this is almost exactly what has happened over the last 116 years. So we're not looking for 100% perfectionism here, but if we can use these cycles to let us know what may happen in the future, it's going to set us up in a much stronger stance so that we can then be more confident in our investments. Pulling this data from all different sections of the market, we can see that from 1928, which is just before the Great Depression, we've got a 13% change in the S&P in that third year. So about an 82% time the market has gone up in that third year. So 8 out of 10 times since 1928. That's 94 years of data here. 8 out of 10 times the market has gone up approximately 13% within that third year, which is what we're coming into in 2023. Since 1833, the third year has been the best year for gains in the stock market. The post-election year, the worst. Midterms, not so great. The year of the election, also good. You're probably wondering, why does this happen and why is it so predictable? Well, for the average person who's not watching these particular videos and not looking at investing, then they're potentially not even looking at the stock market or anything to do with investing in general. What they want to see going into an election year is more money and things that are going to make their life better. And so the people in power, the politicians, those running for presidency, those in power already, are going to be splashing out a lot more money to the market so that they're essentially buying votes. And this happens so often. You can see back all the way to the early 1800s. It's a very repeatable cycle, and many do know about this, but it sometimes is hard to believe that something can repeat so clearly. Now, of course, it's not going to be 100%. We're not looking for 100% perfectionism here, like we just saw with some of this data. 8 out of 10 times, and in other cases, maybe even as close as 9 out of 10 times. So we're going to be on the lookout in case it doesn't exactly happen the way we've seen in the past. But the data is pointing to there being a far higher probability of getting the best gains within this 4-year period and the highest chance of this actually happening. We can't deny what the data has said for, in this case, over or nearly 200 years, since 1833 in this case. More interesting stats about the presidential cycle from 1929 to 2021. So 2021, just last year, the number of recessions starting in the year of the presidential cycle basically shows that the third year, being next year, we have never seen a recession start in that year. And what I just said earlier about the president and the party trying to buy votes, basically splashing a whole lot of money out into the markets, would show why this is the case. But again, we're not looking for 100% perfectionism, even though this chart does show that there have been no recession start within that third year. Potentially, if we go back another 100 years, there may have been 1 or 2 there. Even if we were to get 1 or 2, the chances are very unlikely. And if it was to happen, we can see that we end up getting bigger gains in that year, even if the recession starts. So we could have a recession, but in terms of gains, which is what we're most interested in, we're interested in making money from the market. We have a high probability of seeing gains in the market, even if there was to be a recession starting next year. Now, I've looked at massive cycles, decades to centuries. Let's bring it down onto a shorter term time frame and see if this is all working in together. What we can see from this particular chart here is the seasonality of the gains on the SP 500. There's an old saying, maybe you've heard it, sell in May, go away, and then buy back after Halloween. Now, the buyback after Halloween part is all part of the cycle. This is leading into that Christmas rally. And you can see here through the summer months going back to 1981 to present date that the S&P generally has lower rises and also negative months within that period. So the old saying of sell in May and go away, we're basically through that part now. We've gotten through October, we've gotten through November, and we're heading into December, which is historically one of the highest increasing months on the S&P 500. Now, if we want to take this back another step, looking at every single presidency, no matter which party you're voting for, whether it's Republicans or Democrats, because I know that there are a lot of people who love to be split between the two parties, it really does not matter at all. Going back to 1900, and this particular site shows us the cycles of all the presidencies within this 4-year cycle. Generally, like we saw with the other data, the third year we see the market go up. So whichever president is in power, they want to see the stock market go up. And how do they do that? Basically, get money flowing into the markets however they see fit. Obviously, in the most recent decades, we've had the money printers turning on with a lot of money being pushed into the system. And in recent history, they've always found a way to make that term before the presidential election year. They've made that a good year for people because essentially they're buying votes. So this site here goes all the way back to 1900, showing the movement within that particular third year. This is a historic look at the SP 500. The yellow lines are the election years, and the bigger black spacing here are the first 2 years, and then you have year 3 and year 4. So let's take a look at where we currently are in this particular cycle right now. And if we're to follow what history has shown, year 3 should end up being somewhere above the current closing price for this particular quarter. So each of these candles are a quarter. 8 out of 10 times to 9 out of 10 times, the end of this third year should be above the closing price of this particular quarter. So we look back just at the last cycle, you can see October 2018, the quarter closed at 2,500 points. And the end of the October 2019, we've got to close up at around 3,200 points. And so ideally, that's where we want to see the market. This particular year here, 2014, very, very similar close. We can go back yet again, very, very similar close within this particular cycle. It closed higher 2006 into 2007 and so forth. We can continue to go back in history and just see how these years played out. So what we would want to see moving forward is, of course, the market closing above where we currently are. We have about 25 days to go in this quarter. So wherever we end up closing at the end of this quarter, being the end of December, what we're anticipating is the following 1, 2, 3, 4 quarters eventually to close above that particular price based on history and the data that we've got. Now, with about 190 years of data behind us looking at the Dow Jones and the S&P, what does this look like for Bitcoin, which essentially only has about 12 or so years of data? What I've done here is highlight the election years, the pre-election years, the year that we're going into now, and then the arrows are basically where the election happens. So in terms of the previous 3 periods that we have to show here on Bitcoin, 2 of those were rounding out the lows and giving us excellent entry opportunities. You can see here in 2018 to 2019, the quarter closed at about 3,500, 3,600, and then the last quarter of that pre-election year closed in at 7,100. Going back to 2014 into 2015, the quarter closed at $322, and that final quarter closed at $429. We had the following year where the market was up leading into the election. And then, of course, that following year, it just absolutely boomed from that point. Same sort of thing happened in 2019 leading into 2020, which was the election year. Had the close at 7,100, leading into the following close at 28,980. And as for the first cycle, it was a pretty big boom from that point. The quarter closed at 30 cents, and then it closed out again at $4.72. It was sideways into the election year, and then the year following the election year was also a big boom year. So this has worked out just slightly differently to the S&P over the course of its history. However, what we can see, and because it's a 4-year cycle, and it works pretty well with the 4-year cycle of Bitcoin as well, we're seeing the second year after the election. So basically this year right here, so the 2014 year, the 2018 year, the 2022 year, all be down years. So we've got the election 1 year up, 1 year down, grind a couple of years up from that point. So there's the election, year up, year down, grind, and then try and work its way out. We had the election, year up, down. Potentially, this is going to be a grind, so a good buying opportunity for Bitcoin. before we get into that election year and everyone just has a whole lot of money to splash around. It's important to note that this does not guarantee we get a new all-time high. All we're looking for is the flow of the market. Good times for buying, good times for selling. We're not trying to call an exact sellout all-time high price, and we're not trying to call an all-time cycle low price. We're just looking for a range of a Bitcoin price that historically is shown to be a pretty good opportunity compared to what we've seen in the past, basically looking for those lows and looking for the market to grind higher over the coming years. So if you've made it this far in the bear market, don't let these opportunities go to waste. And if you happen to make it through to the next bull market, try to avoid all of the hype and the hysteria. That is going to be the time that we need to start looking to sell out of positions, even if we don't catch the exact top. There is going to be a lot of hype leading into this next bull market, which, like we've seen, could be a couple of years away. But make no doubts, there will be people calling for 200, 250, 500,000, $1 million Bitcoins and giving all the reasons in the world why it must happen. I'm not guaranteeing any of those prices. I don't even think it'll get to those prices whatsoever. But I do believe that we will get some great swings from this point leading into that particular projection in time to give us enough reward to be worth this particular risk. If you enjoy that, found some value, make sure you like, subscribe to the channel, bell notification icon. Check out the videos that are popping up on your left-hand side for more macro analysis of cryptos and Bitcoin real estate cycles. This is your home of cycles on the internet. I'll see you guys at the next video. Make sure you subscribe to our free newsletter, Alpha Report, down here, top of the video description, coming out this week. Catch you at the next one. Until then, peace out.